Morning, Amanda.
Good morning, Simon. How are you? How's sunny Spain?
Very good, very well indeed. A little bit tired watching the football last night, but there you go. We have England in the next round and the next Tuesday, I think. So
I was going to say it's tiring watching the
Germany's-
football, certainly if you're watching England play. Well,
Yeah.
it's kind of a bit dull, but
there you go. So
Yeah.
who do we have on this week's episode?
I'm delighted to have invited Patrick Way back to chat to us regarding sort of general updates as well, looking at residential property updates, residential property tax updates, looking at SDLT reporting, inheritance tax and so on. So he's going to give us a general overview and just some real insights into what people should be looking for and approaching him with the questions of what they should be asking.
Great.
Good morning, Patrick.
Morning, Patrick.
Morning. Good morning. Nice to see you all. And I'm not so jealous this time, Sam. The last time I saw you, it was very blue sky behind. It looks a bit like England behind, so I'm not as jealous as normal. So that's
house since then, you see. So.
It looks a bit grey.
We've moved to the east end of Marbella now.
Okay. Anyway, well, thank you very much. And I had a nice little chat with Simon and Amanda just now. And what I'm in the process of doing is every now and then I produce a little sort of newsletter for people who are interested, which is called Tax Brief, which I thought was a really good subject actually, because brief can be lawyer and brief can be short. But anyway, no one else seems to think it's as good as I do. But anyway, I thought it was good. And I was just discussing what I'm about to talk about, because I'm in the process of writing an article just on what Amanda said, because everything has changed on property in relation to residential property and also in relation to land generally in the UK and for UK residents, and more importantly, I suspect for a lot of your clients, for non-residents. And so those who are my age, which is probably not many people left actually, but if you're my life was very simple. You didn't pay capital gains tax if you were non-resident, and you just move on to the next box. But now of course, if you're non-resident, you're gonna have to worry about tax on UK land fairly significantly, and that comes across into capital gains tax. So if you've got residential land gains, you've got to worry about that. You've got to worry about ATED, which has been around since 2013. We'll have a little word about what you might do to get rid of that. Inheritance tax, we all know about the structures we used to do for our clients with quite simple. You had you had a foreign company, didn't you, owning UK residents, no inheritance. Well, that doesn't work anymore. And just to make life even worse, they've just introduced, haven't they, a additional 2% rate of stamp duty if you're non-resident buying UK property. So I think I worked out that and younger listeners, please close your ears. But I think I worked out that if you look at the house I'm living in now, the price that we paid for it back in 25 years ago would be less than the stamp duty that you'd have to pay now to buy the house. And that's not just to do with inflation. That is because it's gone from 1% to what is it, a top rate of 15%, something like that. So it is unbelievable. This has sort of crept through, as far as I can see, without anybody noticing, but from our clients. So, and the other thing that made me smile, and Amanda always makes me smile, by the way, was that she said I could be very general. In other words, this is just to sort of raise ideas for us all. And she said it's not death by subsection. So this talk is now called Not Death by Subsection. Anyway, so the starting point is, I'm just looking at my notes, I don't get this too wrong. You've got 2013, everybody knew, as I just said, you didn't have to worry about tax for non-residents. Then along came ATED, which we all know about, annual tax on envelope dwellings, which is basically you had a company, there could be other structures that owned your property in the UK, but they also introduced gains tax. So there was ATED related gains. In 2015, they began to push it out. So you had non-resident capital gains tax, which applied to non-resident persons such as individuals, trustees, and closely held companies in respect of UK residential property interest. And then they had this 2017, they had a consultancy paper. And now from April 2019, everything has completely changed. And so that's really where we are. And one of the other points and the main thing I think is that non-residents have to now be aware that disposals of UK land can give rise to capital gains tax. And in addition, I think one of the killers that's come in relatively recently is this thing about UK residents selling residential land. They now have to report that disposal, don't they? I'm sure you've done this with your clients lots of times, within 30 days. And that's even if they don't make a gain. And I was reading the other day that there are 13,000 people, according to Taxation Magazine, who've suffered a penalty for failing to disclose. So it's something that your average person or even your very bright solicitor would necessarily be aware of. So it is something that I think we all need to be clued up about. So
I think though, Patrick, that's a really important point, is that some of the things that we're doing and dealing with at the moment is where you have in your mind and your own understanding of what the position is and what needs to be paid and the additional surcharges that need to be paid. And we're actually in the process of really correcting mistakes that have been made, and sort of perhaps genuine mistakes whereby it's just become so confusing and convoluted that solicitors are really actually struggling to keep up with understanding what should happen. I know solicitors as a rule are standing back from giving the tax advice rightly, but I think they're also falling into a trap where they think this is a relatively straightforward transaction and no reporting is required or nil is payable on the SDLT, and they're actually getting it wrong. And this is a growing problem that we're coming up against.
There was a case yesterday, I think, where a client transferred a property into a company that he owned, and it was obviously, and the conveyancer said it was exempt. I asked her, because of why you think it's exempt? She says, because the client told me it was. Then they're going to say, well, I don't give any advice on tax. Well, that's fine, but then don't file a return if you don't give advice on tax. Anyway, that's a job. You need to correct that one, but it's quite common.
Yeah. And I mean, what you're saying is obviously absolutely right. And there's quite a market now, isn't there, for people examining SDLT returns because it has become so difficult, particularly with multi-use. And there are lots of cases about what multi-use means. You know, is it 100% residential? What happens with your garden? Is that part of it or not? Because we used to think that the test for determining a dwelling and its garden was the same as the capital gains tax test. I can't remember the exact wording, but for the better use of the house. Yep. But I think there's just been a case, well, just recently, which says that for stamp duty land tax, which I'll probably call stamp duty for now, but for stamp duty, it isn't the capital gains tax test, it's just if the garden is attached. So you know, it's quite a dodgy thing. Anyway, so just going back to where we are. So we've got the, we're going back effectively to 2019, and we've got the quotes, what I call them newish rules, but the new rules in relation to capital gains tax and individuals. What hasn't changed is if you're an individual with a property that you're using in connection with a branch or agency, that's obviously still subject to tax if you're not resident. But the other things, as we were saying, if you've got an interest in UK land, then that is within the charge to capital gains tax as a non-resident individual. Or if you've got a substantial indirect interest in UK land, where the asset in question gets at least 75% of its value from land. So put into English, if you're a closed company, for example, and the value of that closed company is just to 75% in UK land, and you've got a 25% interest or more in that closed company, suddenly you find you've got a capital gains tax charge. So that's something I think that's crept, well, I'm sure all your clients know it, but it's something we have to keep reminding ourselves. And again, with companies, you've got the same sort of thing now. If you've got pretty similar test, if you're a non-resident company, you're going to find that if you've got a substantial interest of that nature or a direct interest in land, you've now got a corporation tax on charitable gains tax issue. So it is something that does take non-resident taxpayers by surprise. And when you add in the UK aspect of having to report residential gains or just residential disposals, the whole thing has changed really, really dramatically. So I think that's really quite a big issue. One of the things is what residential land means for these purposes. And you can have a situation where you have, for capital gains tax purposes, there's the same sort of idea that you have for stamp duty of mixed use. So you could have partly residential and partly not. And you've got, that takes us to the definition of a dwelling. I think everybody thinks we know what a dwelling is, but you know, it's not as straightforward as all that. So you need to speak to these other two guys to find that out. Then I was amused to see that the Office of Tax Simplification has been at work again. I mean, I think I know how I would simplify it, which is one of my friends actually was, I think he was called up to give evidence to one of the sort of parliamentary committees, and he just took with him the Hong Kong tax legislation, which I think is about this big, and then he brought in the UK tax legislation. I think if you just copy the Hong Kong one, it is extraordinary, isn't it? I'm going to stop saying like Methuselah. When I started, there was one orange book and one yellow book. I don't know how many there are. Anyway, so Office of Tax Simplification, one of the things they're saying, picking up what Amanda was saying, was that they're now thinking that, for example, they should talk about how you make better for capital gains tax, deciding what is your principal private residence, because I think that's sort of been a bit tricky. But they think this 30-day period that we talked about is just too short. So they're talking about extending it to 60 days, which I think everybody would agree. So capital gains tax, the situation, as we were just saying, is you've got this new idea that you can be subject to capital gains tax, corporation tax on capital gain in respect of UK land, but a residential property gain, then you have to report that if you're UK, and if you're not UK, you'll still be subject to tax anyway. So the whole thing is quite different. And inheritance tax is something that, again, you know, we all grew up with the idea, as we're saying, that you have this structure with a non-domiciled person, a foreign company holding the land, holding the residence. And that changed relatively recently in 2017. Now, where I have had this recently sort of creep up is not particularly in relation to the sort of thing you might expect, just looking at a normal structure, but it was in just a company reconstruction where you had a situation where the shareholders who were individuals, wanted to even out their ownership of more than one company. And so they just thought they were all non-domiciled. They could just transfer some of the shares across from one to the other. So, you know, one's got 46%, one's got 54. Why doesn't the one give 4% of the shares away? But if you tracked through it, you found you got into the close company, and that close company had residential land. And then you find if that residential land is valuable, and you can say that 5% of your interest or more relates to the underlying UK residence, you've suddenly you're outside the excluded property position. So I think that's something to bear in mind. So just when you're inheritance tax, again, that's changed dramatically. And also look at the definition of what is a residential property interest in those circumstances. It can include loans in certain circumstances. So just be aware of that. Then moving on to ATED, I think we probably did ATED last time, didn't we? So I don't want to sort of go on to it too much, but it strikes me that you've got that again. ATED is just something to keep bearing in mind. And this feeds from inheritance tax because there's no particular point in having this structure anymore for non-domiciliaries, the one involving a company. You want to get rid of it, particularly because if you don't, you've got ATED, and you know the top amount of tax is enormous, isn't it? So I appreciate there aren't many of these properties, but if you've got one of those big properties in London or elsewhere of over 20 million, you're paying £250,000 a year, which is extraordinary.
We have a client at the moment actually that's looking to do exactly that, is to looking to unwind it simply because the annual charges are just penal. I mean, they really are phenomenal. So then it's and then it's a question of unwinding it all again, which can be.
And as you know, the difficulties are often, I mean, not actually, sometimes they've got loans outstanding. I appreciate these clients don't always, but if they've got loans outstanding, you've got to get rid of them. Because if you unwind the company, if you wind up the company while the loan's in place, then you've suddenly got stamp duty because the loan will pass with the land. You've got all the gains that we talked about to be worried about. So if the property's gone up in value, you've got that concern. You want to wind it up so it's not a distribution, because if it's a distribution, it will bring UK source income into charge. And the minute a chap goes and occupies the property, which by definition they are, you've remitted all that foreign source income. So it is a bit of a minefield. And I think the real problem is the stamp duty, which is getting rid of the debt if you can.
Yeah.
HMRC have produced, haven't they, some statements of practice, but they've got the sort of sword of Damocles, which sort of says it should be okay.
Yeah.
So you've got to watch that. So, you know, so there's all those the sort of capital gains tax charge. If there's a trust involved as well, you might have additional trust gains, and it's all very tricky. So, but you know, there we are. The only thing I would say is that the ones I've done recently, you'd want to get local advice, local to the residents of the company, because you want to make sure it's not a distribution. Yeah. And there's a provision, isn't there? And I've got it in front of me. So having said this, not death by subsection, I've got it in front of me. It's ETA 2010 section 1030 tells me that if you do a winding up, it's not a distribution. But of course, it's got to be, that's talking about a UK style winding up. So what if you've got a Channel Island company?
Yeah.
You take advice from Channel Island lawyers and they'll tell you that it's the same. What about a Cayman company, and so on and so forth? So there's all of that. Then stamp duty land tax, that was just, you know, just picking up a little bit more. As we were saying, there are two different rates of tax. One is the residential rate, which is 12% for properties over 1.5 million, with a 3% surcharge if it's your second property. Whereas for non-residential or mixed, it's 5% for over 250,000. So you can see why it is that people, you know, need to speak to you, Amanda, because they need to know, which it is, the difference is extraordinary. And there are cases all the time, aren't there, of people that have understandably misread the rules, and you know, then the stamp office, or whatever they're now called, will pay back the additional amount. So again, you've got a definition of residential property there. And as I was saying, there's a case which I'll come on to in a minute, which talks about the fact that residential property here includes the land, which might be a garden, but it's not the same test as capital gains tax. Quite an interesting case, which called Cartoon, I think I've spelt that right, Khatoun, which was a chap who bought a dwelling in London and the use of a garden square. And the garden square bit, I think, was exempt because it's a license to use land. So that's a plus. And you've got this case, Hyman, which is the case I sort of referred to without mentioning it, which is the one that says the test of whether it's a dwelling is different from capital gains tax. So if it's just, if effectively the land is part of the property, then you have to pay the full residential rate. And again, just by a little beef, what made me smile was that in that case, the taxpayer, they went to the upper tribunal, read out to the tribunal the HMRC manuals. And they said, well, in the manual, you say we apply this test, we apply that test. And he or she got their wrist slapped for being so rude as to mention what the revenue thought the position was, because it was obviously they could change their minds. And back in the day, I had a fantastic judge once who, when we mentioned that we weren't going to rely on a manual, but here was the manual, he actually had got hold of it, and he actually waved it at the tax barrister for HMRC and said, this would have been your skeleton argument, wouldn't it, if you realised you were going to lose? So should we bin it? Anyway, those judges don't exist anymore, so they've obviously been removed. Anyway. But just going back to what we were saying, there's another case here, MAS Fabrics, Hong Kong. And this is a chap who got a firm of advisors to complete his or her, I think it was a him, SDLT return. And I didn't dig in the case. He sought relief from the 15% tax. It wasn't available, but he didn't know it wasn't available. He went ahead and claimed it. And now he's been clobbered with the SDLT, and I presume a penalty as well. So you just have to be very careful. And just as I mentioned, SDLT is now going up to add a 2% surcharge if you're non-resident, with effect from the 1st of April. Wasn't sure why it was the 1st of April, except this, rather than the 6th of April. But again, I don't know whether you've seen, they're talking about moving the tax year from starting on the 6th to the 1st. And if they're going to do that, why not put it on the 1st of January? I mean, that makes sense, doesn't it? I once had to explain to an American why it is why we start on the 6th of April, all to do with the quarter day being in 25th of March and then switch from the Gregorian to the Julian. All that. He looked at me as if I was completely balmy. So I just said, all right, just write down the 6th, would you? So back in the UK, you go for the 1st of January. That's very strange, very quaint. Anyway, so but anyway, we might be moving to the 1st anyway. So you've got this new 2%, and just to show how exciting my life is, I was reading the FT on over the weekend, and there's really quite a good question in that FT money. When I give the chap his due, a chap called Robert Barham was giving the answer. So to the extent it's right, he's got it right. If it's wrong, my apologies. But the question is quite good, actually. It just says, my wife and I are looking to invest in London property. We live in Hong Kong, but we hope to relocate to London. Are there any pitfalls to be aware of before deciding on a purchase? Not really, just go. Yes, there are quite a lot. So first of all, he says, number one, the 2% surcharge is coming. Well, I got that right. And then he says, number two, there's a 3% additional rate if it's your second property. So that's pretty amazing. And then he talks about the new capital gains tax rules, and he confirms that I should have said the rate is 28% on a disposal. So you've got that on the gain. And then it's all just pretty gruesome, really. Then sort of coming towards the end, there's something else that caught my eye, which is this new proposal for a residential property developer tax, which got me a bit concerned until you go into it. It's not as bad as I thought. So it talks about residential property development where you've got it's for companies undertaking UK residential property development, and it's more than, your profits are more than £25 million. And this apparently sitting side by side of what I think is a very welcome tax, which is to do with, people developing high-rise buildings in London, which obviously deal with the appalling Grenfell tragedy. So there's that. What I found interesting that they have not yet got a definition of profits, and they're wondering whether to include losses or something, but I could help them with that. That would seem to me to be quite a good definition of property profits. Anyway, it's going to catch new construction of buildings for sale or for rent, conversion and sale of a development site. So, and then the final thing was just a case where the taxpayer won in the Supreme Court, which is a VAT case, a nature of a sale and leaseback. And it's a case called Balhousi, if I pronounce that right, B-A-L-H-O-U-S-I. And what that was to do with was really, if you have a sale and leaseback, which obviously involves selling it effectively to the funder and then taking a lease back, have you basically kept zero rating in that situation, or is there a moment in time when if you like, the property's no longer yours, you've no longer got an interest in the property? And as it went through the lower courts, they were saying that you did lose your entire interest because there was, if you like, a moment in time when you'd sold the freehold before you got the leasehold back. But one of my favourite judges, Lord Briggs, who's very sensible, he just said, interestingly, I'm not sure it was quite in these words, but you know, if it was tax avoidance, we'd be looking at what the real effect was. We'd be looking at a purposive approach. So well, let's do the same here. This isn't tax avoidance. So we'll just say that the reality is that when you sell and buy back, you haven't really lost your interest in the property. And so the zero rated supply remained. So that's really quite a good case and quite a useful thing that they've actually applied Ramsey to help the taxpayer rather than to clobber them.
Yeah. Surely with that one as well. I mean, it must occur simultaneously. So the sale and the leaseback must all happen.
Yeah.
2 minutes when you're dating the document, when you're dating the first document,
Yes.
and then you date the next one. Surely the whole nature of it would be that it would happen
I agree.
simultaneously.
No, I agree. I agree. I mean, I think you have to meet Lord Briggs. You get on with him very well. I mean, he's sensible. He's very sensible. If you're listening, Lord Briggs, hope you anyway. But seriously, I think it's nice to have a common sense approach. And you look around at the moment. It's very strange. I don't want to bang on too much about litigation, but on a different subject, there was this case involving Raymond Tooth and the meaning of discovery. And he had done a tax scheme. And when he came to put the details, the figures for the tax scheme, he had a partnership loss. But at that time, the online tax return rejected any figure that went into the partnership position. The software couldn't handle it. So he put it somewhere else, and then he put in a really good white space entry, which ended up by saying, you HMRC will disagree with this approach. So I imagine you'll want to start an inquiry. And it went all the way through to the Supreme Court. And the Revenue argued, even in the Supreme Court, that that was a deliberate inaccuracy, and therefore the discovery process allowed them to go careless or even deliberate, which is a 20-year timescale. And they argued that it was obviously deliberate because he meant to do it, and it was obviously an inaccuracy because it was in the wrong place. And I felt sorry for the poor old barrister arguing it because the Supreme Court judges were not having it. So what I'm getting at is that he had lost in the case in the court below 3-0, and then he wins 5-0. So it is quite tricky. And so it's good that you do eventually get some good decisions.
By which time he was bankrupt with the cost.
Probably, but he's got a moral victory.
That's great, Patrick. That's as always.
Okay. Thank you very much, and nice to speak to you both. And I hope
and good to see you. Thanks for all your
take care. All the best.
That's great.
Bye-bye.
Thank you.
Bye-bye.
Bye.
Bye.